time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So this is a company that I thought it would be interesting to talk about it just as well because it does fit into the electrification theme. And then with them coming out with results, very strong Q1 results last Friday, certainly something that's worth reviewing here. So the company AZZ Inc., which under the symbol AZZ on the New York Stock Exchange, and it's about a $1 billion market cap company. So this would be considered a small cap in the US, $41 share price, 1.6% yield. And what they do is they're an industrial company and they provide various services to different end markets, but it's essentially galvanizing and coating solutions. So galvanizing and coating of metal products is typically done to help deal with things like rust and corrosion, typically for steel, as well as other metals, but primarily steel, I believe. So this is an interesting company because they do, as I said, serve some interesting end markets. Taking an excerpt out of the company's website, they mentioned that over the past 60 years, they've been developing comprehensive coating processes to address the challenge of aging infrastructure. So aging infrastructure, this is a theme in the US, which we've invested in through other companies. It's well known that there is a major deficit with respect to spending and investment in US infrastructure that has to be reconciled. So more money is going into it. And that just means roads, bridges, other types of like the power grid, other types of institutional infrastructure as well, transportation infrastructure. There's been an underinvestment in the space, so trillions of dollars need to be invested over the next several years, right? So the fact that it services this industry, and of course, galvanizing and coating, when you're talking about aging infrastructure, you're essentially trying to get the most you can out of your structures so that they don't corrode or rust. But in addition to that, they also service other areas where the company believes that there's secular tailwinds. One of those being the renewable power sector. So they provide their services to the renewable space. So infrastructure renewables fits a little bit into the electrification. Certainly some interesting, attractive end markets here. Looking at the stock price, it's really kind of traded flat over the last year, but even over the last 5 years, some ups and downs, but really kind of ending more or less in the same place. Now, the question is, are they ready for a breakout now? Are we going to see something different in the share price performance given the strong results recently? So let's take a look at those results. As I said, on Friday, they released their Q1 results. Very strong growth in revenues, up 89%. We've seen some gives and takes on the margins here. So gross margin was actually down 420 basis points to 24.8% compared to 29% last year. But they substantially reduced their selling, general and administrative expenses relative to sales, down to 8.1% from 15.5%. So operating margins were up 330 basis points, but adjusted EBITDA margins were down 360. So a lot of gives and takes there. But adjusted EBITDA did grow about 63%, 18% growth in adjusted net income. Only though very muted growth in adjusted EPS, only 3.6%. And a lot of that comes down to an increase in the weighted number of shares outstanding. So when we break into these numbers a little bit to see where the strength is coming from, there's really two segments to the business right now. There's metal coatings and there's pre-coat metals. So metal coatings, this is from what I can tell, you're coating metals after the fact. Pre-coat is when you're coating them essentially at the time of construction. So really it's the pre-coat metal segment that delivered this growth. If we look at operating income, it was about flat in the metal coating segment, up about 3.3%. But pre-coat metals operating income was almost $38 million compared to only $6.6 million, right? So this is really the segment of the business that's been driving those returns. And no surprise, the company actually acquired its pre-coat metals business in 2022. So this strength that we've seen in the current year was really the result of primarily of an acquisition. And Q1 of this year, that was the first full quarter of contribution from this acquisition. The company also noted a couple of other things, such as successfully resolving issues related to excessive customer-owned inventories, which allows them to improve production efficiency, better manage their supply chain, as well opportunities in converting customers from post-paint to pre-paint solutions in various industries. So the pre-paint, of course, being the pre-coat metals business. So when we look at the historical track record of this company, revenue over the last 10 years, there's been a lot of ups and downs. Previous to 2020, revenue more or less, there's consistent growth over time, but not consistently. So this does look like a cyclical business. But then in 2021, they actually divested a major part of their business. This was the infrastructure solutions business. That isn't an area that they wanted to be in long term. So that resulted in a decline in revenues from about 1.06 billion down to 480 million in 2021. And then in 2023, we saw huge growth, fiscal 2023, huge growth in revenues from 525 million to 1.32 billion. And that was due to the purchase of their pre-coat metals business. Now looking at 2024, the company does have guidance. At the midpoint, they're looking at about 1.48 billion in revenue. So going through the guidance here on the sales side for the current year, they're looking at revenue growth in the range of 6 to 17%, adjusted EBITDA growth in the range of 12 to 22%, and then adjusted EPS between 385 and 435, which relative to last year would be about 11 to 25% growth. Taking a look at the balance sheet, there is a fair bit of leverage on the balance sheet. This spiked up when they made their acquisition in 2022. So at the close of the acquisition, they had a leverage ratio of about 4.2 times. They've since reduced with their free cash flow. They've reduced the debt balance. In Q1, for example, they reduced it by 20 million. But they've now gotten that leverage ratio down to about 3.5 times. I still consider that on the high end, but not grossly excessively high. It's at least trending in the right direction. And the company is targeting, a range of 2.5 to 3 times long term. So I would consider that a reasonable range. I'd probably want to see it more in the, 2.5 times area, maybe even 2 to 2.5 times. But, we're not looking at excessive debt levels here or grossly excessive debt levels. And at least we can see those leverage ratios trending in the right direction. And then valuation looks pretty good. Based on the current share price, the midpoint of adjusted EPS guidance, we're looking at about 10 times expected current year's earnings. So certainly a discount to the market. I have no issues with the valuation. The valuation looks pretty good. So just summing this up, our take, positive growth. I mean, they are expecting pretty good growth this year. This will be, largely organic growth because, most of their benefit, they made their acquisition in 2022 towards the end of Q1. So future quarters are going to have that acquisition contribution in there. They have some attractive end markets, which we like. They're deleveraging their balance sheet, the low valuation as well. Now, on the opposite side, we still think even though the balance sheet has been deleveraged, the debt leverage is still on the high end. There's also a wide range in the guidance in terms of what they're expecting. So it's really hard to say where they're going to come in. But 11 to 25%, even on the bottom range, 11% adjusted EPS growth looks fairly reasonable. I will also say that just the recent history of the company disposing of such a substantial portion of the business, as well as making that very large acquisition just recently, that certainly adds to risk. It makes the business difficult to analyze. But overall, I think that this company looks interesting. It's something we're adding to the monitor list. We're going to continue to do our research on it.
Yeah, it's an interesting business. That growth quarter was tremendous on the top line for sure. And I guess the debt, like you said, is an issue. So I think it's a good summary of it to see if there is continued growth going forward. I mean, I looked at analyst estimates going out, like you said, there is growth expected this year, but obviously it's slowed from what we saw in that quarter.
Mm-hmm.
Any
But
comments, you
even in
guys, or you
even
want
in
to
the
move on?
Q1,
Yeah,
I mean, on the per share line, it wasn't that
it's
impressive at all.
not that
We're actually
impressive. No.
looking for an acceleration of per share growth, which is good to see. But
Bottom line or
when it
top line slowing.
top line slowing, bottom line per
Yeah,
share
yeah.
accelerating. Yeah. But whenever you make such a large acquisition, there's only so many unknowns when it comes to integrating it. And they're still in the process of integration. I would say perhaps the latter end of the process, but
Hmm.
we're about a year out from where it was acquired, and this is effectively half or more of the revenue. So it's certainly some risk involved in that, and it's good to see just over the next couple quarters, are they able to hit these targets? Because as I said as well, there's a wide range on the targets.
Yeah. I mean, probably sensitive to the overall economic cycle too. So
Oh, I would think
we
so,
can watch that
absolutely,
for
as
sure.
most
Yeah.
industrial businesses are.
Yeah.
Yeah.
Yeah.